Are you torn between investing in an exchange-traded fund or a mutual fund, or which one of the two is going to be the most suitable based on your financial goals? Hi, my name's M Stackhouse, and in today's video, we're going to discuss some of the mysteries behind ETFs and mutual funds. Now, whether you are a seasoned investor or brand new to investing, understanding these 13 differences is going to be crucial in determining which ones are going to be best for you. So let's dive in. All right, so first things first, what is an exchange-traded fund? Or an ETF is what will be used for short within the rest of this video. More or less, it is a basket of investments that can hold stocks, commodities, bonds, amongst other and product types, whereas a mutual fund is going to be an investment vehicle made up of a pool of funds collected by investors and then deployed by or managed by professionals thereafter. There are 13 differences that I wanted to identify in today's video between the two. So first things first, let's talk about fees and expenses. ETFs or exchange-traded funds generally have lower fees because they're often passively managed. Mutual funds, on the other hand, are actively managed, which means they can have higher fees due to higher operational cost. What we mean by that is whenever something is passively managed, it might only be traded every 90 days or every 30 days. There might be somebody going into that index that was sold to you and making any minor adjustments, whereas a mutual fund could hypothetically on a day-to-day basis buy and sell the underlying investments that are held within the fund. Hence, there might be more operation fees and higher cost from the buys and sells of those investments inside the funds. The next difference is going to be a dividend reinvestment strategy. So in exchange-traded funds, dividends are paid out and can be reinvested, but it is usually a manual process, whereas mutual funds often offer automatic reinvestment of dividends, which can be convenient for the average investor who's looking for long-term growth and not trying to manually go in and make those adjustments on a day-to-day basis or a quarterly basis when those exchange-traded funds most often pay those dividends. Tax efficiency is going to be the next big thing that we want to talk about. Because of how exchange-traded funds are packaged, they tend to be more tax efficient due to the unique way that they are created and redeemed whenever you're buying and selling them within the exchange. Mutual funds, on the other hand, could incur or might incur more capital gains taxes, especially if they are actively managed throughout the year. Now, transparency is another big deal between the two. Exchange-traded funds typically disclose their holdings inside of that basket of investments daily. So if there are any changes, you're going to know that pretty frequently or pretty quickly after the event. Whereas mutual funds, they tend to disclose their holdings less frequently, like monthly or quarterly, just depending on which investment fund you are in. A couple examples of an exchange-traded fund and a mutual fund would be the SPDR S&P 500 ETF, which tracks the S&P 500 index, the 500 biggest companies in the market as of today. And an example of the mutual fund would be the Vanguard Wellington Fund. It's a mix of stocks and bonds that is actively managed, but it's going to try to follow a certain indice. Market impact is another difference between the two. Exchange-traded funds can be influenced by market supply and demand, potentially trading at a premium or discount. This is because whenever you are trading exchange-traded funds, they are going to be bought and sold on the daily basis via when the stock market opens and closes. It can be bought and sold intraday, whereas a mutual fund in general is bought and sold at the end of the close of the day, where you're not going to have any difference in premiums or discounts based on supply and demand within the market. You're just going to purchase the mutual fund at net asset value, which just means the closing price of the previous investments that were inside of the fund when the purchase is made. Initial public offerings is another difference between the two. Exchange-traded funds tend to have an IPO written when they are first launched, meaning that consumers can go out and buy into the fund on the day of the opening of the fund, whereas mutual funds do not have an IPO. They are just open for investment anytime after they launch. As I alluded to earlier with liquidity and trading inside of these different types of products, exchange-traded funds depend on the trading volume within the market, so that's where you can see supply and demand affecting the price of that exchange-traded fund, whereas mutual funds provide liquidity directly from the fund, not relying on market volume. So the positions are bought and sold at the end of the day to raise or invest the funds that are either added or taken away from the fund throughout the pool of investors who are investing in that fund. Investment strategy flexibility. And exchange-traded funds, as I had mentioned in the beginning, are less actively managed, which means that there are not going to be as high of fees inside of them, but have also been deemed more or less passive investment strategies, meaning you're not going to watch it on a day-to-day basis, whereas mutual funds are commonly recognized or associated with active management, meaning day-to-day trading inside of those accounts. Loan facility, this is going to refer to not IRAs for sake of this conversation, but in the event you are wanting to borrow against your investments, exchange traded funds can be lent out for purposes like short selling if you have an expectation of the market going down in the future. That's one way that you can potentially have an opportunity on that investment, whereas mutual funds cannot be lent out for short selling or those other types of things due to the nature of them not trading on the stock market throughout the day and them trading at the end of the closing day whenever a buyer or a seller wants to redeem or add funds to the investment pool offered by the mutual fund. I'm never certain if it's niche or niche or whatever it may be, but access to that particular market is a difference between the two as well. Exchange traded funds can easily target specific sectors, commodities, and international markets, whereas mutual funds are generally broader in focus, meaning more diversified. So there are some niche funds available or niche funds available, but you really have to go digging a lot harder for those versus what you would if you were trying to look at exchange traded funds in return. And lastly, investor ownership. In exchange traded funds, you actually own the shares of the fund itself, not necessarily the underlying assets. Whereas in mutual funds, you own a portion of the underlying assets within the fund. We're going to look at some practical implications that favor exchange traded funds. And on the right-hand side, we're going to look at some practical implications that favor mutual funds. So on the left-hand side, the first favoring of exchange traded funds is going to be active trading and market timing. So a scenario that we might consider is if you're interested in actively trading an account or if you want to capitalize on short-term market movements, exchange traded funds offer that ability, whereas a mutual fund may not, because again, of the condition of wanting to buy into a mutual fund, it's going to be based off of the market closing price of what all the underlying assets were inside of the fund, whereas an exchange traded fund goes up and down on a daily basis by a second-by-second basis when the market is open. Since they do trade like stocks, as again, you're going to get market prices. Now, an example, let's say you anticipate another big announcement from a technology company that could affect the overall technology sector positively. You could go out and try to purchase yourself an exchange traded fund that's going to be focused on that particular sector prior to or right after hearing the positive or negative outlook of the sector or of that particular company that's going to affect the entire sector from your guesstimation. On the right-hand side, let's look at a practical implication for mutual funds now. So automatic reinvestment of dividends, that tends to be very useful for especially a beginner investor who is getting started out. For investors focused on long-term growth that don't want to actively manage their investments, there is a convenience built within them. So whenever the mutual fund pays out dividends or capital gains or whatever it may be, they offer the opportunity most of the time for those dollars to be reinvested back into the fund to buy you fractional shares of that particular mutual fund. An example, let's suppose that you do have a mutual fund that pays you dividends. Instead of receiving the cash inside of the account that you would then deploy back into a mutual fund or into a stock or an exchange traded fund or whatever it may be, you can keep it simple and not have to worry about going in and deploying that cash on your own because it'll just, again, be automatically reinvested inside of the mutual fund. The next practical implication I want to point out is a benefit for an exchange traded fund is going to be lower minimum investments. In most situations, exchange traded funds do not trade for any more than a couple $100. Maybe you might find one for $10 or $20 here or there, which means that individuals with a smaller budget or who wish to gradually invest smaller amounts over time, that might be a more accessible solution for you if it wasn't going to be systematically purchased inside of an account. Since you buy the exchange traded fund at whatever price the exchange traded fund is selling at, that's going to make it very black and white as to what you're getting yourself into inside of the fund as well. So let's imagine you only have $500 to invest. Most mutual funds might require a minimum investment of $1,000 to get into them in the first place because the money managers have to go deploy that money somewhere into the underlying investments that are inside the fund. So they want to have a chunk of change to get started with. Whereas again, a mutual or an exchange traded fund does not have those minimum requirements inside of it. A practical implication on the side of a mutual fund would be that there is professional management for diversification. So let's assume that you are an investor who prefers to have investment professionals manage those funds for you, and you want them to actively manage that fund for you. Well, that's going to be curated by the fund managers who make the decisions about the buying and selling of the underlying assets within the fund, meaning you don't have to be involved in the day-to-day decisions of should we buy company XYZ versus company ABC in an example here. The money managers are going to have an expertise in whatever field or fund that they are participating in, so you can have a little bit of extra confidence knowing that somebody is going to be making informed decisions on your behalf if you decided to participate in it. Practical implication for an exchange traded fund would be if you're wanting lower expenses and you're wanting to just be a passive investor and not really think about the day-to-day intricacies of investing, and you're just wanting to put it away for the long term and not really think about it. This is going to be for individuals who are fee conscious, who are more focused on the fee of the account itself versus the value that's being provided inside of a mutual fund. It's a balancing act of determining which of the two is going to be the best for you. But let's assume that you are interested in maybe following the S&P 500 index, and that's it because you know it's the 500 biggest companies in the United States, and you want that to be a part of the biggest part of your portfolio. You might consider investing passively into an exchange-traded fund that follows the S&P 500 like VOO or the SPDR index that I referred to earlier. Another practical implication for a mutual fund would be that there's simplified rebalancing and diversification inside of the fund. So for investors who are not keen on regularly rebalancing their portfolio, there's a pretty straightforward solution inside of mutual funds. They are a collection of various investments, and they provide automatic diversification, meaning the mutual fund managers are going to be frequently looking at that account and rebalancing it for you based on the overall objective of the mutual fund. And obviously, if you're participating in that mutual fund should be a part of your financial goals. The last two implications, the first one being for an exchange traded fund, again, the tax efficiency inside of the portfolio. So let's say that you are concerned about the tax implications of the portfolio because this is all done outside of an IRA in this example. The unique structure of an exchange traded fund often leads to fewer taxable events such as capital gains when compared to a mutual fund, as I have mentioned earlier on. Let's suppose you decided you wanted to rebalance your account due to changing market conditions. With exchange traded funds, you can sell certain holdings and potentially lower capital gains due to the exchange traded fund's in-kind redemption process compared to the similar transactions in a mutual fund. Let me put that in layman's terms for you. In the event that you bought an exchange traded fund for $10 per share, and that particular investment, throughout the year, you've purchased a couple other lots of that same particular exchange traded fund at maybe higher prices. In the event you're wanting to rebalance your account, you can pick and choose which lot or which shares of those exchange traded funds you want to sell. Meaning you can sell the ones that have the biggest losses or the biggest gains if you're trying to net out your taxes for the end of the year, which can be very useful. It also does not have to worry about wash rules. There are some tricky rules at the end of the year whenever you come to tax loss harvesting, which I'll have another video on at a later point in time, where if you're trying to sell, for example, your Apple stock because you have losses on it somehow for whatever reason in the last 12 months, you would have an opportunity to sell that investment prior to year's end to realize your losses on that investment, but you're not allowed to just buy it the next business day thereafter. You actually have to wait a 30-day window before you could realize those losses. So I couldn't buy or sell my Apple stock on December 31st and then rebuy it back on January 5th and be able to realize those losses in this hypothetical scenario. Whereas I would have to wait until the end of January or 30 days after the sale of the stock in order to realize those gains. So exchange traded funds, what you could do is you can hop from one SPDR exchange traded fund into a VOO exchange traded fund and not have to worry about the tax implications or a wash rule coming into play, which can be very convenient if you do after tax investing. The last practical implication is going to be towards the mutual fund, and it's going to be referring to dollar cost averaging. So it allows for consistent investment for individuals who want to consistently invest on, let's say the first of the month, they want to invest $200. Regardless of the share price of that fund, an investor can put the entire $200 into that particular investment. Whereas if somebody was trying to buy an exchange traded fund, for example, and the exchange traded fund did not, let's say it was trading for $60 per share and you had $200 to invest, well, you would only be able to invest $180 of it if you're buying whole shares inside of that account, meaning 3 shares at $60 a piece. So that extra $20 you would either have to leave in cash and wait until you added more money to the account again, or deploy it elsewhere. Whereas a mutual fund, you would be allowed to put the entire $200 in all at once on the first day of the month, or whatever day of the month you decided you wanted to set up systematic contributions for an example. All right, so I made a chart here. I'm gonna probably link this in the description below. In the event I do not and you are interested in it, please comment on this video to let me know to send this to you. But more or less, it's a pros and cons table of the advantages and disadvantages of mutual funds side by side. So this is more or less a recap of what we just went over, but I would like to be consolidated so it's concise and easy to read. So the pros and cons of aspects, we'll say fees and expenses at first. Exchange traded funds, as we have mentioned, are going to have lower fees and are often passively managed, whereas mutual funds are going to have, especially active ones, are going to have higher fees due to higher management cost and operational cost. Dividend reinvestments. In exchange traded funds, they are generally paid out and have to be reinvested manually, whereas mutual funds, they tend to offer automatic reinvestment of dividends, convenient for long-term growth investors. Tax efficiency is going to be another aspect that we're going to consider that we've talked about. Exchange traded funds, as that long example that I gave you a minute ago, can be more tax efficient due to the unique redemption process, whereas mutual funds might incur more capital gains, especially if they've been actively managed, because the fund managers have to declare that inside of the fund and pass that along to the investors. Transparency. Typically, the exchange traded funds are going to disclose their underlying holdings on a daily basis, whereas a mutual fund does it less frequently. That could be anywhere from monthly to quarterly, or whatever the rules are of the mutual fund that you decided to invest into. A couple of examples of an exchange traded fund and a mutual fund are going to be the SPDR S&P 500 exchange traded fund, which tracks the 500 biggest companies in the United States as of today, whereas the Vanguard Wellington Fund is going to be a mix of stocks and bonds and is going to try to follow a different indice of maybe the total market impact. So exchange traded funds, they do trade at a premium or a discount depending on the day and the situation due to supply and demand, whereas mutual funds do not, because they are bought and sold based on the net asset value, which is determined at the end of the trading day. So there's never any premiums or discounts offered on mutual funds. Initial public offerings, again, once an IPO has been, there is an IPO that's launched on an exchange traded fund, whereas there is not inside of a mutual fund. It's just open to the public for investment, and then you get to go into it thereafter. Liquidity. Liquidity depends on the trading volume of the market. Again, we talked about it could be at a premium or a discount, depending on if somebody's wanting to buy the fund that you're trying to sell, or vice versa, sell the fund that you're trying to buy. Whereas again, on a mutual fund, whatever dollars you say that you are planning to invest in the fund will be determined after the end of the trading day, because you'll be buying in at the net asset value on the investment itself. Investment strategy and flexibility. Investment strategy for exchange traded funds, they're often going to be passively managed, but they also can be actively managed, whereas mutual funds are most often associated with active management, hence the higher fees inside of them. Loan facility, this is again not going to be inside of IRAs that we're talking about. It's going to be after-tax accounts. You can short sell exchange traded funds, where you cannot short sell mutual funds. Access to niche or niche markets. Exchange traded funds, you will have a much easier time trying to find those particular markets that you're trying to participate in, because they can narrow the window. Whereas mutual funds, they're going to be more diversified by nature, meaning they're going to be spread out across more investments. So it's going to be harder to target particular sectors if that's a goal of yours whenever you're strategy. Intraday pricing, as we've discussed, exchange traded funds are going to have a price that's going to move up and down every second of the day, whereas a mutual fund is not going to go up or down until the end of the day based on what all of the performance of the underlying investments were, so they could declare a new. Investor ownership is the last piece of this puzzle. You own the shares of the fund itself, not the underlying assets inside of an exchange traded fund, whereas in a mutual fund, you actually own a portion of the underlying assets inside of the fund. So ownership is going to be a difference between the two. So in conclusion, which one is the best? Per the usual, there is no exact answer to this question, but there are 4 questions or 3 questions that I tend to tell everybody to ask themselves in determining which one is going to be the best for them. First off, what are your financial goals with the money that you are considering investing? Is it a short-term investment? Is it a long-term investment? Is it for legacy? Is it for retirement income? Is it for future health expenses, rainy day fund, whatever it may be? Then, would you prefer active or passive management and the fees associated with that? And then lastly, what account type are you considering investing in, and do the taxes matter? So it's kind of a two-pronged question. I mention that because if you are considering an after-tax account that does not have to follow the retirement age rules, if you will, an exchange traded fund could be more advantageous if you want to talk about passive investment strategy and tax loss harvesting, whereas a mutual fund could be very beneficial inside of a retirement account because you're not going to have to worry about capital gains and dividend reinvestments and those affecting your overall bottom dollar for tax sake. So diversification is very important in either scenario. So I think they both are viable solutions for most individuals, but remember, personal finance is personal. So please consider your unique situation before making any decisions or talk with your own financial professional. So I hope you derive value from today's video. In the event that you did, please consider leaving me a thumbs up and sharing it with a friend or a family member. And lastly, subscribing to the channel, as it really does help the channel grow and get to a new audience so I can hopefully provide more and more value to the public and yourselves. So thank you for your time. Hope you enjoyed the presentation. Let me know if you have any questions.